Thank you for being here, Real Talker. It can sometimes feel impossible to save up enough money to buy a home. It's a good idea to discuss the basics on actually how to save up enough money for a down payment and what lenders look for when you actually go and buy a property. Let's be real here. If you want to buy real estate, you have to come up enough money to actually buy a property. You might ask, is it really possible? How should you do that? Today, we are going to tell you a few simple strategies on how you can start saving for your money to buy your future home, and you can be sure that you are building the right financial foundation now. We are going to talk about the basics, about exactly how to save up enough money for a down payment. Also, we will discuss what lenders look for when they determine whether or not they're going to lend you money. If you're new here, join the Real Talker community by subscribing to the channel. So before we dive into the aspects of saving money, we want you to know that it's going to require you a few things ahead of time from you. These are the basic information that you must really need to know first. You have to know the lender requirements. Number 1, the vital thing for you to have is a good credit score. Credit scores are numbers between 300 to 850. These scores determine how likely you can repay loans on time and in full. This will also help lenders determine whether or not you can pay your debts. Now, preferably, you want high credit score to qualify for the best rates. Once you get above an 800 credit score, the rates start lowering and the lender starts giving you credits in which they can lower your interest or even point that interest towards getting your loan paid off sooner. If you choose to borrow less than 450 or 300, there is a possibility the real estate will charge you more interest. It's important not to do that because it means that your property will become too expensive for the real estate market. It will then become more difficult to find opportunities in the market to make a profit. It's important for you to have a good credit score. Poor credit scores can really limit your opportunities in many different areas. You want to avoid poor credit scores, so you should work on finding ways to improve them not only for personal financial benefits, but also as a way of enhancing your life. Keeping a good credit score is important for your financial future. Attaining good credit will help you to save money and find the best terms with lenders, including mortgage loans. Number 2, before lenders will approve any loan, you should know that the thing that most lenders are going to want to see is 2 years of tax returns. Lenders will want to see other evidence of your income. Now, some lenders will need 2 years of tax returns. That also depends on your job, even if you are a W-2 or 1099 or how you make your money. Still, a lot of lenders will generally want 2 years of tax returns. Their goal is to make sure that you continue making money and it gets better over time. They need to know where your income went this year or if you earn no money. This is because cryptocurrency is fluctuating in an unpredictable way. They want to make sure it doesn't happen, so they actually want to reward people by taking off some of the tax return when you know that you will be buying real estate in the next 2 years. What lenders look at is your net income after all of your deductions. The reason why is because lenders are going to loan you based on the lower amounts. You should show as much income as possible if you know you're going to buy real estate over the next few years. It makes a lender more likely to give you a big loan with it. Number 3, lenders want to see your bank statements. Sometimes it will be what they really want to see, the last 2 months of your bank statements. Sometimes it goes as far back as 6 months. It's really to check what money is coming in and where money is coming out. If they notice a whole bunch of cash deposits being made, that might be somewhat suspicious. If you do transactions or if they see the money coming out of your account in cash, like every single day, they might think and be concerned about your spending habits. So the point of looking at bank statements is to track exactly where your money is coming and going. Usually, banks like to do this to keep track of how much money you are saving and how much money you are spending. Number 4, banks want to see your cash reserves. What are cash reserves? Cash reserves allow individuals and companies to meet short-term and emergency funding needs. Or also, you can set aside a certain amount of money in order to cover expenses. Sometimes, if an expense occurs that was not anticipated and unplanned, you can use the cash reserves you have. Maintaining a reserve gives you the freedom to avoid credit card debt and getting additional loan debt. Being financially secure is an effective way for you to deal with unexpected obligations. Having cash reserves can provide you with significant purchases and ensure financial stability both now and in the future. A bank will often want to see somewhere between 3 and 6 months worth of mortgage, interest, taxes, and insurance payments in a liquid account. So they want to see enough money stand by that you have an emergency fund set aside. This is just to make sure that you don't buy this deal. It's about avoiding paying for purchases now and then having financial problems later on. This is what causes new debt. How can you save up enough money? Let's talk about how to save up enough money on real estate. One of the requirements is that you put some money down to purchase a home. This is called your down payment. To facilitate this process, banks require that you put down a certain amount of money in the deal, and they expect you to be able to afford the cost associated with owning a house. Now, the usual down payment in the market, generally many people are putting about 20% down. For some, people are putting a little bit less, about 15%. This gives the bank some cushion in the event that they need to foreclose, that you take the first 15 to 20% off the loss on that deal. If you don't make 20% down payment on the home loan, usually you'll need to pay PMI or private mortgage insurance with the rest of your mortgage payment. Banks find it more difficult to foreclose on those homes that are low in value because you have less money tied up in the property. This is to make sure that they get paid back when you don't pay them back. PMI usually ranges from 0.5% to 1% of the total loan amount annually, or sometimes you could pay it up front ahead of time, and that money does not go towards your equity. It's just an additional fee tacked onto your loan. There are a lot of factors to consider when deciding whether it's worth it to pay the PMI, or if you should just wait until the market really starts picking up. If you are confident and you think that the market is going to soar and just going to continue to go up, it might be better to jump in now, get the PMI just to get the deal versus paying 10% a year later. But again, it's risky for you to take out a personal loan without a required down payment. Usually, PMI is added to the amount, and that can add up to a lot of money over time. So what we recommend is, if there is less than 20% equity in the home before purchase and you enter into a PMI loan agreement, the best fit is to refinance what you have 20% equity in your property, just to get rid of that PMI and then go on as usual without the PMI. If you are lucky, you may be able to get an offer accepted and close a deal with 3.5% or 5%. It all depends on your situation, circumstances, market, what income bracket you are in, and how competitive it is. But if you want to look into VA loans, sometimes you can even put 0 down on the deal or even less than 10% down. These are all things you should look into regardless of whether or not the strategies of saving are different. Now, here's how you can save for a down payment. Making savings one of your top priorities. Your priorities will change. You might have to spread your budget differently to make everything work out. And when you're saving up for a house, it's really no different than saving up for absolutely anything else. Except it's saving to buy a house, of course. Your income plus your expenses. Now, what's the most important when it comes to doing this is just your income in relation to your expenses. This is exactly why banks will want to see 2 years of tax returns. They want to see bank statements. They want to pull your credit. They want to know everything about you to know how much you're making in relation to how much you are spending. This is why it's not enough to just come up with a 20% down payment and then assume that anything else you can qualify for just because you have the 20% down. Banks want to make sure you have consistent income and relatively low expenses. The next one is to track your spending. Tracking your spending is the most important step towards saving money. This might sound like a no-brainer, but it is really important when you're trying to save anything. It can be hard to know what to cut out of your budget, but there are certain things you do every day. A great way to save more money is to make small changes in your life. like turning off the lights when you leave a room. Little changes can really add up to a much bigger amount over time. Finding ways to save money is more of a team effort than ever before. Educate yourself on a few simple things that will significantly reduce your expenses and buy smarter. Finding smart ways to save a ton of money as early as possible. So another way to save money is to automate your savings. The money is automatically saved every single month, so it doesn't even hit your bank account. Out of sight, out of mind is the best way to save money. If you have a few bank accounts, you might want to consider using your bank savings account for every single deposit. We recommend you do this. You might find this as one of the helpful strategies. Banks will be looking to see if your mortgage and property debt is more than 40% of your net income. This can completely change the way loans are handled. By showing the bank how much you have saved, you are telling them that you are spending less money on needs and lowering your debt to income ratio. This means that 40% is going to be a lot higher because you're showing less money spent. Budgeting and living below your means and saving as much money as possible helps you get what you want. What about if you don't have any money left over to save? What if you can't really save anything? Here are 2 suggestions for you. The first one is to look at your expenses. You should be able to find a few things that you don't really need that you can start cutting back on and start saving. The reality of the situation is that you need to make more money. If you don't have enough income, unfortunately, there's no way around it. You need to earn more if you don't want to feel broke. You'll need to make large changes in your lifestyle to get out on the side of this reality if you're not earning enough money. Becoming focused on increasing your income will help with your financial commitment. Reducing expenses as much as possible is essential. It might be worth it to take a part-time job and just focus on making this dream happen. It might also be worth something else to figure out what other jobs might help you with this goal. Maybe start taking some online courses or focusing on expanding your skills. And once you're able to make more money, it's important not to just save, but to be conscious of your expenses. Make a conscious effort to keep the difference between what you spend now and what you are earning in the future when you start making some more money. If you want it bad enough, you will somehow find a way to make it work. This is one thing that with time and patience will pay off big time in the future, and also has huge potential when done properly. Now, the second suggestion is to keep your savings in a high-interest savings account. It's wise to save some money, and the smartest place to save it is in a high-yield savings account. You can earn on what you have saved over time, so don't worry about starting with a small amount of money. You can save up to start earning interest. There are no additional costs with this savings account. It comes with low minimum deposits, no monthly fees, and low balance requirements that make it a good option for your savings. It's important to keep the funds that you don't need in a savings account instead of accumulating money in your checking account. Savings accounts can earn interest, so it pays to keep cash anywhere else. This will allow you to make a deposit outside your normal banking, giving you a safe place to put your money. You can also save your money and do things like attaining a big savings goal. Final thoughts. Saving up for a house and saving in general is really just all about how much income you have, how much you spend on things like your house, and how much of that money you can save. You must have a variety of money-making, spending, and saving goals for it to really work out. Don't forget that banks review your financial information to determine the risks of giving you a loan. Characteristics like patience, discipline, and consistency can help you make it further. Is it really worth it? Yes, it's worth it. Sacrifice will help any type of success, but sacrifices are required for many people, and the reality is that not everyone will be okay with it. So we encourage you to keep track of everything you spend money on, so you can cut back on everything except what makes you the most money. It's tough, but overall, it is well worth it. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.